It's not above zero yet. It's going higher. It's getting closer to backwardation, but it's still below the 0% mark over here. So when this red line goes above zero, that is a silver shortage. That is silver backwardation. It happened in 1998. I think this was the Asian financial crisis or something. It happened in 2003. It happened very briefly in 2011 during the silver spike, but it has not happened yet. Now, it should be monitored, but the silver co-basis is still negative, which means you still get money to hoard silver and not disgorge it.
Recent market activity has placed silver squarely in the spotlight, as investors increasingly examine the growing divergence between London spot prices and New York futures. While some reports suggest that silver is entering backwardation, Rafi Faber clarifies that this is primarily a technical observation rather than an urgent signal of supply disruption. In New York, silver remains in contango, reflecting sufficient supply to satisfy both industrial demand and investor interest. These regional variations, while noteworthy, are not unprecedented. They illustrate the complex and interconnected nature of global silver markets, where differences in settlement mechanisms, storage availability, and regional demand can create temporary price gaps without signaling a systemic shortage. Faber underscores that true backwardation, where immediate demand for physical silver dramatically outpaces available supply, is historically rare and usually coincides with periods of extreme market stress. Past episodes, such as the dramatic spike in silver prices in 1980 and specific moments during the Asian financial crisis, demonstrate the conditions required for backwardation to trigger rapid and sustained price surges. Currently, industry participants can still source silver for manufacturing, and coin shops maintain inventory for retail buyers, indicating that although market interest is elevated, the system has not reached a critical tipping point. This balance between heightened demand and steady supply highlights the market's resilience and the nuanced forces shaping price dynamics across different trading hubs. Looking ahead, Faber advises investors to navigate the silver market with careful strategy and informed attention. The uptick in short-term contract activity signals growing engagement, yet the full onset of backwardation has not arrived, making cautious observation essential. Tracking settlement prices, monitoring physical demand, and maintaining liquidity are crucial for those seeking to capitalize on market movements without overexposing themselves to volatility. Now, we present the clips from Rafi Faber's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
While we see that silver is back over 50, we hit 50 over here to an all-time high of 51 something. This is the London spot contract. This is not New York. And we here hit 51 again. And now we fell back to 48.40 and now we're back over 50. Things are getting really, really volatile because the monetary system is being torn apart at the seams. But what is going on? It's when we're talking about backwardation in terms of New York minus London, and if it's negative, it's not exactly rare. You can see here if we look at this bottom graph in the gold charts or us graph here of the near month minus the spot. Spot means London, near month means near month in New York. You can see here that very often it's below zero. So technically, as they are counting this as backwardation, technically you could call it that. But it happens very often. It's almost a mirror image. It's not rare. And it's happening again. You have a -2 spread between the London, which is more expensive, and the New York, which is cheaper. So you're saying, oh, spot is more expensive than futures. Okay, fine, but not a big deal. So what is causing this? And you can see here when we zoom in just for the last 5 years, you can see this happens not all the time, right? And this is pretty extreme. It is extreme. This is not nothing, but it's still not backwardation. You can see the last time this happened was in 2023. It happened in 2024 also, and now it's happening now at the same extent as 2023. That spot silver in London is more expensive than the nearest future in New York. It happens, but it's not rare. So why is this happening? Well, very simple explanation for that. Why is London spot more expensive than New York futures? It's because the supply in New York is extremely high and it's coming from London and other places. So you see here that the supply of eligible silver, this is eligible silver, it's not for sale, but it is in storage. It's at an all-time high of 339.61 million ounces. And you have the registered silver, which is also right near an all-time high. The all-time high was 200 million ounces. Now it's 186 million ounces. This is all-time high of both eligible and registered silver for sale in New York. So the supplies of silver in New York are very, very high. And the ETFs are mostly not stored in New York, they are stored in London. And that is what's causing the shortage in London. You can see here the number here is 790 million ounces is the total. This is not the float. And a lot of that is owned by SLV ETF and other ETFs that the silver sits there in London. And you can see last year the float was higher. It was above 800,000, 800 million, sorry, 800 million ounces because this is thousands of ounces. It was above 800 million ounces and now it's below 800 million ounces. And the ETFs, even though they haven't come anywhere close to where they were in terms of silver storage during silver squeeze, they are higher than they were last year. So you have a severe shortage of silver specifically in London, which is why the spot price is more expensive in London and cheaper in New York. But this is not backwardation. What is backwardation? You see here, this is a contango chart. These are silver prices just strictly in New York. October is here, and it's at 46. This is from yesterday or 2 days ago, so the prices are a little bit off. But you can see here it goes to $52 from July 2030, and this is the cash price in London over here. So you can see this is a contango chart. What would backwardation look like? It would look like this. I just took the chart and I flipped it. You can see this is why the letters are backwards. But if everything was the same here and this is what the chart looked like, and forget about this cash bar, this would be backwardation. We are not there yet, but this sometimes happens in the oil market. It sometimes happens in the gasoline market. It sometimes happens in wheat. Very rarely does it ever happen in silver. When it does, that'll be the end game. We're not there yet. In a table, this is what it would look like backwardation. This is a settlement price. This is what I put the black rectangle around. So you can see the settlement price for October silver, November silver, December silver. Settlement price simply means that it's a volume weighted price, and these need to be calculated because it helps the CME calculate how much margin a client needs to have in his account to maintain his position, and that is based on a settlement price. It's volume weighted, so if most of the volume is around, let's say, 47 and some volume and a little bit of volume is around 42, 43, I'm just giving an example, then the volume weighted average of the price for that day's settlement would be whatever this is. And this price is going up as the expiration gets older and older. Sorry, newer and new, whatever, into the future, more into the future and more into the future. You can see here 50, 46.85, it gets higher, 46.97, 47.15, 47.36. It gets higher as we go into the future. That is contango, not backwardation. When this flips, we'll be in silver backwardation, and that would be a sign of near endgame. So here we have a chart from Monetary Metals from Keith Weiner. He is the expert in gold and silver backwardation. His entire thesis is that permanent gold backwardation, which will also be permanent silver backwardation, will be the end of the monetary system. So that means by these charts, the co-basis. The co-basis is the amount of money you get to disgorge silver, which means that is in backwardation. You should get money to hoard silver, which means there is an excess of silver. But if you get money to disgorge silver, that means there's a silver shortage. And we can see here that this red line, it's not above zero yet. It's going higher. It's getting closer to backwardation, but it's still below the 0% mark over here. So when this red line goes above zero, that is a silver shortage. That is silver backwardation. It happened in 1998. I think this was the Asian financial crisis or something. It happened in 2003. It happened very briefly in 2011 during the silver spike, but it has not happened yet. Now, it should be monitored, but the silver co-basis is still negative, which means you still get money to hoard silver and not disgorge it. So if we look at another chart, which is the same thing, but a different way of counting it, you can see here, this is the same chart from Gold Charts or Us. This is the silver co-basis. It's not called that here, but that's what it is. When it goes below zero, that is backwardation. So we had backwardation in what year is this? This is 76, 77, 78. Early 1978, we had silver backwardation, and that eventually led to the silver spike of 1980, 2 years later. And we had brief backwardation here. You can see the 1998 backwardation during the Asian financial crisis. You can see very briefly in 2003. That's the line we saw back here on this chart. If you look at 2003 and you zoom in a little bit, you can see that this is the spike. This is the spike in 2003. This is the spike in 1998. And you can see those same spikes in the opposite direction because it's the inverse in 1998 and 2003 over here. And it happened briefly in 2021. This is silver squeeze right here at the beginning of 2021, slight silver backwardation. But here, that's not what's happening now. So I know this is a lot of material taken very fast, and I'm speaking fast because I don't know why. It's Shabbos Chol Hamoed Sukkos tonight, so I got to do this quickly. And yeah, basically why I think this is important, why you got to be careful here is not to follow the hype of silver's in backwardation. We got to buy all silver right now. Stay calm. Wall Street or whoever is in charge of the COMEX and all those other people that don't want the monetary system to break down, they're waiting for everyone to get in the wrong side, or not necessarily the wrong side, but they're all waiting for everyone to load up as much as they can in a panic before there actually is a panic, and then they're looking to fleece us. So just be careful. Don't get too hyped up yet. I know silver's past 50. Let's see what it does now. Stay cautious. Have your silver, but also have your liquidity so that you don't get caught in this dangerous game that is still being led by banksters and all those other people that have a lot of dollars to manipulate the system. Just be careful here. Silver's not in backwardation yet, but it's going to be. When it does, I will report it.
The silver market is showing signs of an unprecedented global squeeze, according to Mike Maloney. Drawing on historical data and current market activity, Maloney highlights that while silver has surpassed prior record closes, including the iconic January 1980 highs, this is not merely a fleeting technical anomaly. Charts going back decades reveal the evolution of price trends, including the famous 45-year cup and handle pattern, which has propelled silver from $25 to nearly $50. While paper markets fueled by futures contracts often spark claims of manipulation, Maloney underscores that margin requirement increases, such as the recent 5.8% hike for gold and 9.3% for silver at the COMEX, can create temporary volatility, forcing leveraged traders to sell, yet the underlying upward trend remains intact. The real driver behind the market surge, according to Maloney, is a global physical bottleneck. Refineries are currently backed up for weeks, unable to process incoming doré bars into deliverable bullion or coins. Meanwhile, over-the-counter silver is being absorbed into ETFs and high-demand markets such as India, leaving virtually no free-floating silver available. This constrained supply, combined with robust physical demand, creates upward pressure on prices that cannot be ignored. Maloney stresses that investors should recognize this dynamic as a structural factor rather than just paper market noise, and that the shortage at the delivery and refining level could support sustained price appreciation well into the future.
I made this chart. It looks a little funny. Why? Because when you go back all the way to January 18th, 1980, stock charts does not have intraday pricing. All they have is the close. That's the data that they've got. So the open is 49.45, the high was 49.45, the low was 49.45, and the close was 49.45. And so it's just a single line. But what I wanted to show you, this was the previous high back in, so this is the close that people refer to back in 1980. That is the high. So from Peter Spina, silver closes at historic highs in London. Highest price close in history, exceeds January 1980's prior record close of 49.45, and it closed at 49.68 rounded. Silver set to break intraday record highs from January 18, 1980. Chicago Board of Trade, $52.80. And so I made this chart just a little while ago. This goes back to Monday before last. And when you're looking at these candles, for anybody that doesn't know how to read them, the fat part, when it's a hollow body candle like this, the fat part at the bottom is the open, and then the intraday price action as things are going up and down is the wicks that might stick out of both ends, maybe not like this candle, and then the close is up at the top of the fat portion of the body. A black candle, this was the open, the intraday, and then the close is at the bottom. So Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, boom. And then something happened, something changed, and the price fell dramatically and closed below its open. However, the close was still above the previous day's close. So based on a closing basis, this has still continued an uptrend. But this is, I think it's called a shooting star. It's a bad omen. It's technically it's supposed to not be a good sign. However, since it closed above its previous close, it's still an uptrend, and it doesn't matter. And when everybody looks at this, they scream manipulation. It's got to be manipulation. Well, in this case, it was, and I think I've got some evidence here. I think what happened. So, Bob Coleman, CME margin increase alert. COMEX increases margin requirement for gold 5.8% and silver 9.3%. So, what I believe happened is it opened and it just started, it may have fallen a little and then starts taking off like a rocket. And right about there, they announced the change in margin requirements. What does that do to all the people that are holding futures, which is where the spot price is derived by the paper market? And so all these people that are gambling on the commodities exchange, they've got these highly leveraged positions, and then they get a margin requirement, which is basically a margin call. They either have to cough up that cash or sell part of their position. And so it causes selling pressure. So if they announce it there, people were selling and selling and selling, and then the market closed there. And that avoids forced liquidation. Tomorrow, if they haven't coughed up the cash or sold part of their position, the brokerage house will do it for them and keep whatever they need to keep. But it doesn't matter. This is the 45-year cup and handle that I was the first one to identify. Everybody, including me, we were all focused on this cup and handle that had happened from 2012 until 2024. And then, I said when it breaks this resistance line here, we're going to have a slingshot move. And boy, has it been a slingshot from $25 to $49. It's huge. But what I wanted to show you is I tried my best. You can only move that blue line by 1 pixel at a time with the up and down arrows. And so I tried my best to get this on 49.45. 49.32 is as close as I could get it. The overlap, it doesn't really overlap because this line stopped at the pixel below this line. Anyway, it shows that there's a little gap there, and it looks like it's touching there. However, this is a linear chart where it's a constant percentage change. And so each inch of space on here is the same percentage change as the last inch of space. And it tends to compress all of the numbers at the top and expand the ones on the bottom. If you go to a linear chart, that is a constant amount of change instead of percentage of change. And so that expands the bottom, expands the top, and we have this constant amount change. And now you can really see a gap there. We are way beyond the 2011 high at this point, and the tiny gap that's left is just a few pennies. And we have basically, at this point, completed the 45-year cup and handle that is predicting triple-digit silver, and I think it's going to be mid-triple digits. So from James Henry Anderson, good friend of mine, he was my the general manager of goldsilver.com when we started out. And he says that Japan Bullion Market Association spokesman is this guy, Bruce Akamizu, hearing short squeeze in silver. Seems nobody's got silver in London, and lease rates skyrocketed 20 to 30% for short term if you're lucky enough to find a lender. Silver squeeze is on. Silver lease rates now much higher than that of platinum. So there is definitely a squeeze, and it is global. This is Eric Young again. Robert Gottlieb, quote, over-the-counter silver going to ETFs and India demand, basically no free-floating silver left. And Eric says this is the first time ever I read Gottlieb write that there is basically no free-floating silver left.
Looking ahead, the combination of limited physical availability and persistent demand suggests that silver could continue to experience strong upward pressure. As refineries struggle to convert raw material into market-ready bullion, supply constraints are likely to intensify, potentially outpacing the current buying appetite from both investors and industrial users. This imbalance may create a period of heightened volatility where short-term swings occur, but the overall trajectory favors higher prices. Those holding physical silver could find their assets appreciating steadily, while speculative participants may face increasing risk due to margin adjustments and rapid market reactions. In this environment, the market may gradually transition from relying on paper contracts to emphasizing tangible holdings, reinforcing silver's role as a sought-after store of value amid uncertainty. Given the current supply constraints and market dynamics, how do you anticipate silver prices moving in the near future? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.